Welcome back. Salary advances for Co-operative Bank of Kenya to customers doubled last year on the back of COVID-19 disruptions in the corporate sector that saw massive job cuts and pay cuts in the sector. In a story published on the Business Daily, 105.1 billion shillings salary advances were given to customers through the M-Corp Cash online platform, which was a huge jump from 52.28 billion shillings in the preceding similar period a year before, which was also pushed cumulatively. The short-term loans issued via mobile phones rise by 92% to 122.23 billion at the end of December. 86% of the cumulative e-credit, or 105.113 billion, relates to salary advances called e-flexi, while the remainder was taken up by businesses. At this point, let me introduce Arnold Nkasale to the conversation. Arnold, what does this data indicate about the performance of the corporate sector amid the COVID-19 pandemic? Is there any relation?
Yes, thank you so much. Yes, there's a big correlation with that.
Yes.
I think you have to take into account several things. Number one, month on month from January, we've been seeing inflation increase. Month of January was about 5.6, February 5.7, and I think by end of Q1 we were talking about figures of about 5.9% as far as inflation is concerned. Then again, you also need to look at employment data. Data which was released back in 2019, actually last year, capturing data as of 2019, indicated that 3 million out of 18 million employees were formal. Essentially, that means only 3 million employees are formally employed out of 18 million, which is only about 20% of the amount of people who are employed in the Kenyan economy.
Yes.
So if you factor in COVID-19, if you factor in what happened last year with COVID-19 and what we're seeing this year with the third wave of COVID-19, those numbers are likely to go down. And you realize, under any particular household, one employed individual supports about 5 to 10 other individuals. So that has essentially put stress on the formally employed individuals. And if you look at the data which is being released by Co-op Bank, those are essentially facilities which are tailor-made for employed individuals.
Yes.
And you look at where those monies are going, some of those monies are simply going to financing of household costs, financing of daily expenditures. It's not that they're going to maybe injection of funds to business or something of the sort. So it simply means the current amount of people who are employed are under stress in terms of the obligations that they have on a day-to-day basis. If you want to get a better picture of that, you may need also to look at the numbers as far as other facilities are concerned, maybe Fuliza.
Yes.
Towards the end of last year, Fuliza was doing about $1 billion per month. As at March this year, Fuliza is doing 1.2 billion per month.
Yes.
So if you look at those dynamics, whatever we're seeing at Co-op Bank is simply a fraction of what is essentially going on in the entire economy. So it simply means that is a reflection of an ailing economy. Inflation is going up. Unfortunately, the rebound, the economic recovery that we expected has slowed down because of the third wave of coronavirus. So it's simply an indication of what's going on the ground. And it simply shows that formal employment, those who are essentially getting basic salaries from formal employment are under stress as far as expenditures are concerned. Bear that fact also in mind that the number of formally employed people is also going down, because with this third wave, with the new lockdown, it simply means that more people have lost their jobs. More entities have actually had to close shop,
yes,
especially in the hospitality industry. So this is just an indication of a fraction of what is going on in the economy. And we hope that government intervention will kickstart the economy and hopefully reverse these trends.
Pretty much. All right. Sid, let me just get you in as well this morning. And I want us to really look at the performance of a cooperative bank of Kenya in just the year ended December 2020. And if you can actually look at it right now, if you look at what has been their profit vis-a-vis percentage of growth, then you can actually see in 2020, they had a negative 24.44% growth in that specific segment as well, coming from a 12.4% growth in 2019. Now, if you look at that value of money that they're actually lending, does this really form a very good section for cooperative banks' growth, or they're going to get exposed if indeed whatever is happening in the economy right now continues to happen?
Thanks, Simba. For central for Co-op Bank to be exposed, I mean, before we go there, let's understand how these salary advances are structured.
Yes.
They are generally lower risk loans, given that the salary advances are they don't come with they're more attractive one for the people taking out those loans, because they don't come with conditions such as requirements to have guarantees or any security. So that on its own allows the common population to actually access credit.
Yes.
Banks would just generally, the only requirement that would be there would be maintenance of a salary account. So given that how it's structured, once the salary comes into that account, or once the employer pays that employee the particular salary, it's deducted. The bank deducts the loan amounts or the repayment amounts and interest at source, and this reduces the bank's risk significantly.
Yes.
Because you are quote unquote guaranteed repayment of the loan said person has taken. So in that respect, even if there is an increase in the short-term access to credit and salary advances, I wouldn't want to say that it would negatively affect Co-op Bank, given the low risk nature. So non-performance of such loans generally would not come into fruition, at least. So
yes.
Just based off that, the risk level being generally lower, I don't see how it would affect their profitability or their growth levels in the future. And also, if you look at why they have negative growth levels, I mean, there's been a decrease in demand generally for bigger loans. Or what we've seen more so, the trend for the past 1 year has been bigger corporations restructuring their current funding and borrowing arrangements with banks. People are more reluctant to actually take on more advances or increase their debt burden.
Yes.
During this time, because just the general slowdown in the economy. And coupled on all this, only reason we see an increase in salary advances is because of the factors mentioned earlier, being job losses, people having to take pay cuts, and when you're sustaining other people's livelihoods based off your one salary, it becomes a burden, and you would have no choice but to try and access credit just to survive.
Joan, clear for us this conversation on these salary advances that we're talking about this morning. And I want you to attach it to personal loans. There's also information that we got from the CBK that if you look at how personal loans were really affected in terms of defaulting, they really weathered the COVID-19 pandemic really good, because they only accounted for 1.9 B out of the 69 B. Is this a good segment for banks now under the COVID-19 pandemic? Because it looks as if it's really the only good source now.
In terms of salary advance, I
Yes.
think that just a kind of segment of one bank, which is Cooperative Bank, I
Yes.
believe that the same, like was mentioned earlier, that the same is happening in other banks that are facilitating the same to their customers in terms of KCB and other smaller banks in terms of their customers who can be able to afford to take salary loans. So the same is happening. It's a ripple effect in the economy, of course. I'm not sure that this is the only alternative that banks should be looking at in terms of sustaining their, their small income margins. Maybe like I want to give an example of a bank like NCBA, which has, for me, it has it has grown up its portfolio in terms of what else can I get from my customer apart from salary advance? What other products can I introduce to my customer? Remember, Cooperative Bank was a bank that was grown from cooperatives. So what else can Cooperative Bank do to the cooperative society to grow its portfolio and income levels at this particular time during COVID? So for me, I think it's yes, it is sustainable for banks in the short term, but in the long term, they need to relook at what else they can do for their customer in this particular season of COVID.
Yes, pretty much. Now, Arnold, let's cross on to the last issue that we have for you this morning. What data by the Central Bank of Kenya, CBK, shows that the value of cash outside the banking system rebounded in February to a record high of 231.37 billion from 226.7 billion in January, under optimism that the economy could rebound. There's a however general feeling in the economy that despite the optimism and increased money circulation, many Kenyans are still feeling the impact of the pandemic following the massive job losses that sent 1.72 million adult Kenyans home, that saw the unemployment rate stand at 7.2 in September. All right, let's look at that data this morning so we can actually see that trend in terms of currency outside banks in the economy. And you can actually see that there was that little rebound that actually started in July of 2020 and has continued to go all the way up to where we are right now, where the CBK is saying that in February it was at 231.37 billion. Arnold, this is a direct question. Does an increase in money circulation directly translate to increased economic activity? Therefore, good lives.
Thank you. From a basic perspective, yes.
Yes.
But I think we have to look at this from various angles. Yeah. Number one, I think most of this data was gotten towards Q4 of last year when there was a feeling that the economy was recovering. There was a comeback as far as economic activities on the manufacturing industry is concerned, exports are concerned, and the feeling was that the economy was on its way to recovery. And if you look at what we call money circulation, it's essentially the trickle-down effect of cash. What do you have in your hand? If the trickle-down is okay, then it simply means that everyone has access to money, business is moving, both in the large-scale and the small-scale areas of the economy.
Yes.
However, if you look at it from the Kenyan perspective, I think the averages at times don't really paint accurate pictures, because you're looking at a situation whereby data we were looking at last year meant that last year several things happened. Last year, but several things happened. You're looking at COVID-19, and then you're also looking at what happened with the Kenyan currency when we were changing the currency, moving from essentially doing away with the 1,000 shilling note. So several things happened. At some point, there was a surge in the monies which were in people's hands vis-a-vis what was held in banks as far as deposits are concerned. And people who deal in industries like sale of motor vehicles will talk about guys who are coming in to buy vehicles cash. And at the same time, you're looking at the performance index as far as purchasing powers are concerned. There was an increase as far as money circulation was concerned towards the end of last year. So on a basic level, if money is in people's hands, that signifies an improved economy. However, if you look at things like inflation, then how much more shillings do you need for you to make basic purchases? And then one other thing you may need also to look at, there's another report which came out I think last month,
Yes,
on the number of 1 shilling coins which are circulating in the economy, but are not being valued as far as purchasing power is concerned. We're talking about a figure of about a billion, about 955 million shillings of 1 shilling coins, which had not been properly accounted for and had not been properly utilized as far as basic economics are concerned, buying and selling of commodities. So in the Kenyan scenario, it's a peculiar dynamic as far as the, money in our hands is concerned. If you factor in inflation and you factor in the circulation of money vis-a-vis what is being held in banks versus what people have, it's not a straightforward kind of answer that I can give. Again, you may also need to factor in that at some point, most traders wanted an easy reach to their monies.
yes.
So most of them are simply holding on to their money. Instead of placing it in conventional banks, some of them are simply keeping it either in their homes or in safes, or in places which they felt they could easily access the funds. These also include alternative places where they can put their money, not necessarily your banks, but even in SACCOs and credit-only institutions. So it's a dynamic which we may need to continue to observe, and hopefully, if the government takes some measures with the current lockdown, maybe just to try and stimulate the economy, we may have something different to write home about. But on the basic sense, if there's circulation of money, then that would simply mean that the economy is improving. But with the Kenyan scenario, it's a different story altogether.
Pretty much. Said, let me get your sentiments as well. Is it okay for us to also look at other factors that are in operation right now in the economy, despite us talking about that 231 that is in circulation in the economy? The resumption of taxes, the going back to the corporation tax that we also didn't have last year, could it be the reason why majority of Kenyans are saying, well, we don't feel it?
Sorry, Simba.
Yeah, yes. John, I seem to be breaking up with that. Said I will be getting back to him. John, talk to us. Is it because we are now back to the tax measures that we were not experiencing last year, why majority of Kenyans don't feel this slight recovery? It's a big recovery, but then we don't feel the effect of this money that is in translation, that is in circulation within the economy.
Okay, the money that came in, but also is going out. It's not like it's, it's not like it's given time to settle down in terms of, we are paying higher costs in terms of fuel.
Yes.
So really, what you're spending in terms of fuel now is higher, and yet lesser in terms of what you are able to put into your vehicles. So for example, you will spend 500 but less for less fuel. So that means that the money has come in, yes, but your because of inflation, your expenses have also increased. So with the same amount of money, you will not spend more, but in fact spend less. So that's one of the reasons why we don't feel the money in the system, because of those reasons. Food prices went up because of that. Other costs have also gone up because of just the effect of fuel on the economy. And basically, this money is also being used to basic needs, to eat, power and things around the home. So it's not being put into projects that would generate more income, and therefore, of course, employ more people and have more people back in the economy with the money circulating. So it's just being used for subsistence consumption. So we can't see the money in the system because of the projects are not even there in the first place.
Yes.
So it's a catch-22.
It's a catch-22. Said, can you confirm whether you can get me, sir? Said, can you get me? unfortunately, we don't have Sid joining us now. And that's actually how we come to the end of our conversation this morning. Sid, can you get me? Unfortunately, we can't. I want to say thank you very much to Arnold and Joan for joining us this morning. You can actually take them back to YouTube for the time they came to the studio and actually get to watch their sentiments again and share your comments once you're there and subscribe. Thank you very much for being part and parcel of our show this morning.